Hello and welcome to a video overview of the Becketts phased investment strategy. Just to set forward a few key concepts, essentially this is focused on clients who may be investing a capital sum and are considering how they are going to enter the markets. Firstly, it's really important to note that timing of the markets is near impossible. Investment markets rise more often than they fall, and so therefore, in normal circumstances, investing a full capital sum at the outset is going to be the most beneficial. Nevertheless, clients may want to be opportunistic or may be nervous and therefore more cautious about entering markets at a certain point in time, and so a phased investment strategy can then work. At Becketts, we believe that structure and discipline when doing this is very important. Essentially, we want to minimise the amount of emotional input that we have into the strategy and set guardrails and structures before we begin. At Becketts, setting a breach point adds an opportunistic element. It allows for those investors with a slightly higher risk tolerance or a slightly higher view and objective to enter at a low market point to benefit. Nevertheless, as with almost everything in life, it works both ways. It can work both in your favour if markets are falling, and it can work against you if markets are rising. Here we have an overview of the entry to markets in normal circumstances. We have an investor who has capital to invest, and the FTSE 100 starting value is around 7,100. At Becketts, we like to invest on a weekly basis because this maximises the number of entry points to the market and therefore provides a greater balance and average of your initial investment point. Each of the crosses show a time where new money has been invested, and we would invest on an equal measure across all of those different points, either over a 1 month, 3 month, 6 month or 12-month period, depending on our conversations with our clients. We would always set a breach point. Now this can be based on the FTSE 100, the FTSE 500, the S&P 500 or any other metric that we agree upon, but we will set a point that we feel the markets are extremely well priced for a long-term investor. In this scenario, that is when the FTSE 100 falls below 6,000 at 5,999. But in normal circumstances, investments will be made each week and will be fully invested over the time. Where investments have gone in below the initial starting point, they will be in more profit, and where investments have gone in above, they will be in at a loss at the point that you are fully invested. Nevertheless, you can average out all of those points to ensure that you haven't invested on day one and then suddenly markets have crashed on day two. And this is the ideal scenario for somebody investing in this manner, negative performing markets. So essentially what's happened is we've started the process on the left with the FTSE starting at 7,100. We've been disciplined and consistent with our approach, investing on a weekly basis, up until the breach point has been hit. And that's indicated by the blue cross. The FTSE 100 has fallen below 6,000. We've had a brief conversation with our client, and we have then fully invested all remaining capital at that point in time. This allows them to be investing at a point that they feel is very attractive as a long-term investor. What's important to note is that in nearly all times of market stress, the markets will fall further than your investment as a blue cross here, and often rise much more quickly than we would be able to react to. And so this scenario of setting that structured point means that you may not be hitting the bottom of markets, but you know you'll be entering at a period that you're very happy with for a long-term investor. As I mentioned, this can also work against you, and so here we have positive performing markets where the FTSE started at 7,100. Each of those weekly investment periods have continued to be invested. However, the investment markets have risen over that time. It's never even gotten close to the breach point. And this is probably even more common than the falling markets. Now what that means is that each of those crosses that you've invested above 7,100 could have been invested at a lower point with a longer amount of time to grow had you invested all of your capital day one. The positive slant to this is that although some of those investments will be at a small loss or won't have entered at 7,100, the money's invested at 7,100 and on the path towards the higher figure on the right should all be in positive performance, albeit slightly less than they could have been. So it can dampen some of the pain of missing out. Hopefully this gives you an idea about some different ways to enter markets, especially in times of stress or if you're trying to be opportunistic. We really must stress that timing is almost impossible. It's time in the markets, not timing of the markets, that is the most successful for most investors. Thank you for your time, and as ever, if you want to get in touch with Becketts, we would love to hear from you. The best email address to use is info@beckettsfs.co.uk.